It's when the market thinks they're going to lower interest rates that really is going to be the impetus for that. But gold could easily reach 2,500 this year. I mean, we're closing today as you and I talk at around 2,300. So 2,500 is not really a stretch. And you know, in gold bull markets, the price goes on surges and corrections, surges and corrections. So we've had a surge. We have a little correction now. We could have a little bit more correction, and then it'll go in another surge. That's the way the gold price acts. And so 2,500 is easily within reach this year.
Gold prices surged in Asian trading on Friday, buoyed by indications of a cooling U.S. labor market. This put downward pressure on the dollar and Treasury yields, consequently boosting the value of the precious metal. By the week's close, gold is anticipated to achieve a more than 2% increase, marking its first weekly gain in 3 weeks, although still lagging behind the record highs seen in late April. JeffClark, editor of thegoldadvisor.com, suggests that with current gold prices hovering around $2,300 per ounce, reaching $2,500 this year is a feasible target. Gold markets traditionally experience surges and corrections despite fluctuations, with $2,500 as attainable during the next surge. Gold has already surged more than 12% this year, despite delays in anticipated Federal Reserve rate cuts. Higher interest rates are typically viewed negatively for gold as it doesn't offer interest payments. The primary determinant of the gold price outlook over the past year has been Federal Reserve policy. While the Fed is expected to lower rates this year, it is indicated that it needs to see more evidence of inflation easing first. Next week's inflation data will provide further insights into the state of the U.S. economy. Clark notes that while potential Fed actions, such as raising interest rates, could temporarily impact gold prices, other factors like monetary concerns, financial vulnerabilities, and market dynamics are likely to exert a more significant long-term influence. Despite a 44% increase in the major minor ETF GDX since the end of February, overall performance remains relatively weak given the recent breakout in gold prices above 13-year resistance. However, a mean reversion in mining stocks has already commenced, with limited downside experienced despite a $150 correction in gold prices. Clark highlights that while the rally in gold prices has yet to benefit junior mining stocks fully, this delay presents an opportunity for investors to position themselves in these companies before broader market interest drives up their prices. Join us as we delve into Jeff Clark's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
In my opinion, Paul, if you look back at the dates and when this gold run started, it was actually on leap year day, February 29th, when all of a sudden the market realized, hey, the Fed may lower rates sooner than they said they would, at least sooner than they expected. And sure enough, the gold price ignited on that day and has really not looked back. So it's pulled back a little bit as you and I talked today, but that's when it all ignited. And I think when that gold price broke through previous all-time highs, that forced a lot of short covering, some momentum chasers jumped in, and of course you have the backdrop of the vulnerabilities in our system that support that, including central bank buying. So I think it all started then, and we really haven't looked back then. So now the Fed has said they may have, leave rates higher for longer, but really the gold price being where it's at shows just how strong it is right now. Central bank gold buying has been a net positive for almost 15 years now. So it's really a show of strength that after 15 years of net positive buying, that as a group, they're just hitting their strongest level ever. So this could be a banner year for central bank gold buying. That supports the price. In my humble opinion, that is not why the gold price is higher. I think central bank gold buying actually supports the price, though. And so that's an important component of this market. And it's really a show of strength that they're just reaching their crescendo now after 15 years of positive net purchases. It's when the market thinks they're going to lower interest rates that really is going to be the impetus for that. But gold could easily reach 2,500 this year. I mean, we're closing today as you and I talk at around 2,300. So 2,500 is not really a stretch. And in gold bull markets, the price goes on surges and corrections, surges and corrections. So we've had a surge. We have a little correction now. We could have a little bit more correction, and then it'll go in another surge. That's the way the gold price acts. And so 2,500 is easily within reach this year. Oh, lots of things. The Fed could raise rates. That would be probably the biggest short-term indicator that the gold price could suffer in the near term. But that's a short-term factor only. So in the long run, the Fed isn't going to have the big impact on the gold price. It's going to be other things, whether it be monetary concerns, financial concerns, market concerns. There's a lot of vulnerabilities in the system right now. It could be the lack of a discovery, though, that could hold the gold price back. It would be nice to see another big discovery made this year, if not more than one. So there are several factors that could hold it back, but the factors that could push the price higher, in my opinion, outweigh the factors that could push it lower. Well, very simply, that has not trickled down into the junior sector yet. Even some of the majors haven't moved all that much. Some have. Look at Agnico Eagle and what it's done the past couple months. But the money flows into gold first, and then it flows into the producers. Then it'll flow into the developers. Then it'll flow into the juniors. So that's its historical pattern in terms of money flows. And so it's not unusual to see that the juniors have not moved yet. That underscores the opportunity, and it does tell you, in my opinion, that the clock has started. So you have a window of time to make sure you have the exposure you want in the juniors before the money trickles into that sector. Because once it does, then you'll be trying to jump on a moving train.
When things move, they tend to move pretty quickly.
They do, especially in this factor, in this industry, yes.
While the gold price currently stands 20% above its Q3 2011 high of $1,925, the GDX trades at a significant discount of 40% to its former all-time high, near $60 in 2011. Following robust reports from top gold miners Newmont Corporation and Agnico Eagle mines at the end of April, continued robust miner earnings have shown mining margins accelerating faster than inflation during the Q1 earnings season. Despite this, junior miners have yet to emerge as a standout opportunity. A wave of mergers and acquisitions, coupled with speculation, is poised to unlock the potential of this overlooked industry segment. According to Clark, the mining industry has experienced a notable lack of exploration, development, and discoveries. This has resulted in a situation where it's more cost-effective for companies to pursue M&A activities to acquire ounces rather than undertake their own exploration and development projects. Let's get back to the interview.
In my view, there's been some M&A, but we're at the very beginning of this cycle. There's been a lack of exploration, a lack of development, a lack of discoveries. So M&A is going to happen. There's a chart a week of the lack of exploration, the number of ounces that are being discovered versus historical, versus what is needed really to maintain the industry. And so there's going to be a lot more M&A ahead. It's a lot cheaper right now to just buy ounces than it is to try and explore and develop and permit and put into production. So M&A is really at the beginning. I do expect it to not only continue, but to pick up steam. Well, the average premium historically is about 35%. They've certainly been higher, and sometimes they're lower, but it is easier to get the bigger premium right now. The worry is that they buy out a stock that you're down 50% on, and they only give you a 35% premium. So I'm hoping we get a lift in the sector before that happens, but that's coming. That train is starting to heat up now, so it's coming. And as an investor, you can choose to sell those shares when the deal closes if you want and capture the premium that way, or you can ride the producer higher, depends on what your strategy is. And as an investor, you can do either one. Whether you keep the shares no longer depends on the company that was bought out, but depends on the bigger company, obviously, as a whole, and what they're going to do and what their trajectory is, what their strategy is, and that sort of thing. My wish would be all the ones in my portfolio get bought out, of course. The interesting thing is, though, there are a number of companies out there, we own some of them, that already have resources. And they're trying to not just prove up those resources into a higher category, but to find more ounces. And so those companies, I think once the money starts to trickle down and the producers are more profitable given the higher gold price, that's another impetus that could really speed up the M&A process. They're more profitable now. They can buy more now. But I think they might reach down to those companies first that either have a big resource that they're going to want, or one that could be a lot bigger that they're going to want. But the targets initially, in my opinion, are going to be those that already have ounces, and they don't have 500,000 ounces, but they have 2 million, 3 million, 4 million, and 5 million ounces. Those are going to be the first targets, I think.
While gold continues to show resilience amidst economic fluctuations, junior mining stocks have yet to capitalize on the rally fully. The prevalence of mergers and acquisitions in the mining industry points to underlying challenges in exploration and development. Considering these factors, how do you envision the future of the gold market and its impact on investment strategies? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.